Hello everyone. Next we have Rahul Bajoria, the chief economist at Barclays. He's the man with unparalleled experience, knowledge and skill. He has helped Barclays having 330 years of history and expertise in banking and 1.349 trillion pound in assets to move, lend, invest and protect money for customers worldwide. He is also the author of renowned and best-selling book, The Story of Reserve Bank of India. Mr. Rahul Bajoria has delivered mastery in many arenas of human endeavor and continues to re-establish the legacy of excellence in every domain he associates with. SRCC Business Conclave is proud and privileged to have him. It is a venerated moment to witness him as a key speaker. We are confident today's exchange will lead to discovery of unprecedented insights. The format of the session is Sir will give a keynote address followed by a moderated Q&A session.
Uh, Thank you, Kapish. Can I begin now?
Yes, sir, you can.
Thank you so much for that very generous introduction. It's absolutely lovely to be here. In a virtual format to be speaking to the students here. I mean, I know I'm talking to the best and the brightest of the country. At SRCC. While I went to St. Xavier's College in Calcutta, but then I had the pleasure of having quite a few friends who went to SRCC, and I also when I was a student, I used to come down for your economics societies events, every now and then. So it's wonderful, to be in back in touch. So what I thought today was that out of the 30 minutes that we have, roughly speaking, I will talk a little bit about, the way the monetary policy has been shaping up in the country, especially in the last few years, where there's been, tremendous amount of focus on what the central bank has been up to, and especially the individuals who have been running the central bank. There's been plenty of discussion, debate, and also a lot of hand wringing about the state of monetary policy and the way it is being run in the country. So it's I thought I would take some time to try and declutter it for all the students here, and the other dignitaries in about 15-20 minutes. So I think a very major turning point, after, say, the late 90s, when Dr. Bimal Jalan had come to the Reserve Bank of India, was that India's external issues, particularly around balance of payments, financing, started to get resolved as our foreign reserves started to increase. So a lot of the monetary policy, design, or also the practical, application of monetary policy tools became a little bit more self-sustaining and a little bit more inward-looking, right? Because India's history, if you look at India's monetary history over the last 75 years or so, it has always been kind of held hostage, like any other emerging market or a frontier market, to variations and the vagaries of external fluctuations, whether it's commodity prices or dollar strength, dollar weakness, and that used to have a very debilitating impact, time and time again for our economy. But then after India started building a lot of foreign reserves, which the process kind of started in the late 90s, early 2000s, India's economic policy became a lot more sustainable, especially from a monetary standpoint, that we were able to pass very path-breaking changes in terms of the FRBM Act, the automatic deficit monetization, which used to happen till the late 90s, stopped. And so India's monetary policy became a lot more independent. Now, fast forward to 2008 crisis and then the 2013 taper tantrum. The entire edifice on which monetary policy was kind of designed was that you have a little bit of capital inflows, you run a small but a relatively sticky current account deficit in order to attract more capital in the country, and as a result you will have slightly higher potential growth. Was obviously misused, and to a certain extent, it ended up driving very persistently high inflation, which kind of led to a scenario in which we had to adopt an inflation targeting framework, right? Because between the periods of 2000, I would say 7 almost till 2013, the biggest issue that India was facing from a policy perspective was very high and sticky inflation, because our demand side conditions were very quite strong. and supply side was not keeping up pace. And as a result of it, monetary policy conditions were always quite loose. Real rates were quite negative. The current account deficit was quite wide, which basically meant that the policy conditions were not appropriate for macro stability. Now, in that particular context, when India adopted the inflation targeting framework in 2014, we kind of adopted it in an informal manner. Dr. Rajan was kind of following a glide path at that point, and then in 2016 we adopted it, in principle, and also from a legal standpoint. That was a very key turning point, because India coming into an inflation targeting framework meant that policymakers at the RBI had a very explicit target, right, of kind of controlling inflation. But then at the same time, one of the most interesting facets of a country like India is that our food inflation obviously is a function of the weather related vagaries, right? So rainfall tends to have a very significant impact on our food production. But then at the same time, what has happened is that with new modern technology coming in, India is actually now becoming very self sufficient as far as most of the food items that we would consume on a day to day basis, right? So out of the 10 major subgroups, India is now self sufficient in basically 9 out of 10 groups, except oil seeds. So basically cooking oil is imported from other countries, but India does have a fair amount of self sufficiency in every single other aspect, apart from like very specialized food items like say kiwis or dragon fruit, etc. India produces basically everything for itself. And so from that standpoint, inflation suddenly started coming down. Now there is a a thought process, and I would say I also kind of subscribe to it, is that maybe in order to fight inflation, we ended up keeping monetary conditions too tight, at a time when the growth, global growth was slowing. Global growth was fairly mediocre in the last decade, and at the same time we had a situation where in order to meet our inflation target, we were probably sacrificing a little bit too much of growth, that our real rates were very high. As a result of it, India's growth continued to slow through 2016, 2017, 2018. You had this, obviously the double shock of demonetization and the GST implementation, which also had relatively small impact on economic outlook, but certainly it played a part as well. And as a result of that, we were already having a slowing down economy, before the COVID crisis kind of came to us. Now, one of the interesting things that I find in my study and analysis of the central bank in India is that it is at the end of the day a fairly collaborative organization. Like while individuals have become a lot more in focus, they have been kind of brought about in focus in the last 20 25 years, as the economy has grown, as the relevance of the central bank in the economic policy has increased. But then still, it has to work very much in tandem with what the government of India is doing, and that's by design, not necessarily by choice, right? And from that perspective, when the COVID crisis hit last year, right, RBI was already in an easing cycle, right? RBI started cutting rates when the current governor Shaktikant Das took charge in I think December 2019, sorry 2018. He started cutting, with along with the MPC, started cutting rates in February 2019, and as a result of that, we had about close to around about 140 basis 130 basis points of rate cuts, which was done before the COVID crisis. And because I think fiscal policy tends to work with a long lag, right? And a lot of times you tend to see the impact of fiscal policy, especially capex, has to go through a life cycle. I think it was correctly gauged by the government and by the RBI that the RBI would really front load a lot of its monetary measures in order to prevent markets from really having a bit of a meltdown. So in March last year, the RBI came out, started cutting rates. They injected a huge amounts of liquidity. They continue to do so through the year, where we saw them all put together. By our estimates, they put in at least 11 trillion INR of direct liquidity. So through various schemes like LTROs, TLTROs, they did targeted liquidity injections. And at the same time, they were also undertaking a fair amount of forward guidance, right? So as students of economics, even if you are from a business background, you would be learning some economics. And as you would know, the power of rational expectations is quite strong, and it's a very important uh, behavior setting tool that that if firms, individuals would tend to take. And as a result of that, RBI was basically communicating very, very strong policy support for ensuring that there is a growth recovery. Now liquidity, there's often a question and there's a lot of confabulation between what is the role of liquidity versus what is the role of credit, right? Effectively, bank credit is not getting created because bank credit growth is quite small right now, but then it is also a function of how much working capital requirement is there, right? If you're not producing, you're not going to be taking working capital, so you would actually scale back. I think a lot of us, who would have credit cards, or who would have, say, regular spending, felt that our credit card bills were declining simply because we were not out during the COVID pandemic, out at restaurants. We were not really going out to clubs, or going out to pubs. And so as a result of that, a lot of discretionary spending kind of got pulled back. But then we saw credit card credit also declining at the margin in the system because spending was not taking place. As we have seen a lot of this spending come back, and that's also kind of manifesting in the way the COVID cases are increasing across the country. I mean, I'm sitting in Mumbai. Here everything feels very normal when we step out. So from that standpoint, it feels like credit demand is coming back, and liquidity is very important because, again, as students of economics, you would know that monetary policy tends to work with a lag as far as lending rates are concerned, right? So just because you are cutting rates today as a central bank, you're not going to see that getting transmitted across to everyone, unless and until the deposit costs are going down, right? So RBI, any bank, is basically in the business of financial intermediation, and as a result of that, you need to see that deposit costs have to decline before lending costs come down, in order to make sure that banks don't make any losses. One of the more endearing parts, or one of the more I would say positive surprises that have come out of this particular pandemic, is that businesses have been very, very nimble, and they have managed leverage quite well. And they seem to be, and I was listening to the talk of a lot of people from the startup industry before my session, which was quite enlightening. I think, as they were saying, that there's this bootstrap mentality which is starting to come about in a lot of big businesses as well, that they did not really waste the crisis. They adopted technology very, very strongly. They also managed to cut down their costs, and manage to reduce their leverage costs by refinancing debt. And so as a result of that, the scarring in the banking system has been relatively limited in the current environment. And from that particular standpoint, I think one of the better outcomes, and this I would completely credit the RBI on it, is that they have been able to basically prevent there being a big repeat of what India's banking system has been going through the last 4 or 5 years, where we have had high NPAs, low credit demand, low credit growth. And so economic vibrancy was kind of lost as a result of, I think, us not completely avoiding, but certainly minimizing this entire cycle from playing out. I think a lot of optimism is now getting priced into, whether you look at our asset prices or you look at our growth outlooks. A lot of optimism is coming because the risks of scarring in the system, so scarring basically would be lost capacity loss appears to be limited. And one of the reasons why I think people are so optimistic that there's been less scarring is because financial sector scarring appears to be limited, right? So the first sector which will get impacted if businesses are shutting down is going to be the financial sector, and that's clearly not happening. The other reason I would say a lot of optimism is kind of built in right now is because what has happened with our external position, right? So as I was saying earlier, one of the big challenges for India, even after we have built up large foreign reserves, has been the fact that every time there's a global crisis, our current account deficit is very large. We tend to kind of get straight jacketed because of a large current account deficit or lack of foreign reserves, which basically triggers a run on the currency. in the last 1 year, one of the more serendipitous positives that have come out of this particular crisis has been the fact that our foreign reserves have increased tremendously. We have not only accumulated more than $100 billion of foreign reserves in spot, we also have now a forward book, which is basically forward commitments from the central bank to buy dollars in the future, from domestic players, close to around $70 billion, right? So in effect, our foreign reserves are already above $650 billion if you add the two numbers. And so that is a bit of a game changer, simply because even if India starts to keep monetary conditions fairly accommodative, our fiscal policy, which we have not really spoken about, becomes a lot more, remains a lot more expansionary. There will be a time when our current account deficit will widen, but because of these large foreign reserves, I am reasonably confident that we will be able to smooth out any major volatility in our currency markets, and also as a result probably will be able to smooth out any major business cycles that might come about. So I think right now there is a lot of reason to feel optimistic. I know that COVID cases are increasing, but then vaccinations are also increasing very rapidly. So one of the things I've been doing is that I've been looking at comparing the ratio between the number of vaccinations being done on a daily basis and the number of active cases we are running. And while that graph is looking, it's been coming down, it still looks pretty healthy. So I would still impart a fair amount of optimism, saying that that bump up is going to be a bit of a speed breaker, but not exactly a complete blockade in terms of India's economic revival, and which continues to look very, very strong. So maybe with that, I'm happy to take questions on any issues pertaining to the economy. It's been a pleasure talking to you. Yeah, thanks.
Yes, sir. Thank you. So the moderator of the Q&A session is the third year student of Shri Ram College of Commerce, Adarsh Raj.
Hi,
Hello, sir.
Adarsh.
Hello, sir. So, firstly, a very good evening, sir, and thank you for enlightening the students about monetary policy through your address. We at SRCC Business Conclave are immensely proud to have you with us. And with thousands of students waiting to hear your views, sir, can I start with the round of questions?
Yes, yes, please.
Okay. So first question which we have is, so as you also mentioned in your address that regarding the inflation targeting approach of RBI, so do you believe that the Indian monetary policy transition from the multiple indicators approach to an inflation targeting approach driven only by the one incident of taper tantrum was the correct thing to do, especially since former governors Sir Bimal Jalan and Dr. Reddy had not been in favor of it. So what used to happen was good, or is what's happening better? So what's your take on this?
Yeah, so I think at that particular point, when India was coming out of almost 3-4 years of very persistently high inflation, and I remember distinctly writing about the economy at that point, through those years, and inflation really was looking very, very difficult to tame down, right? I mean, India was running a very large subsidy regime on the fuel price side. So I think adopting inflation targeting as a very explicit target was probably the right call at that particular point in time. I know there was some resistance in the system, but then I think what was also probably an issue was that for maybe a few years in between, around 2017, 2018, monetary conditions were a bit too tight, given the underlying economic situation. And so as a result, I think a lot of people kind of put that blame on inflation targeting itself. I think in the way we are currently interpreting the mandate, so if you look at last year, out of almost 12 months, around, I think 9 or 10 months we had above target inflation, but then RBI was not hiking rates, right? So I think that kind of a situational interpretation of inflation is very, very important, and that's what's kind of been happening. So in a way, I think what we have right now, in terms of the way we are using inflation targeting as a guiding principle, but not necessarily being dogmatic about it, is the right approach and the right way to go. And that's the reason why I think the entire framework has been approved again for another 5 years. And in my view, that was the right call to make.
Okay, sir. Thank you. Sir, my second question is, so also talked about India's foreign exchange reserves. So as India's foreign exchange reserves reach an all-time high every new week, reflecting excellent exchange rate management strategy by the RBI. So, however, the impact of these inflows on domestic liquidity is hardly sterilized. So, do you think that this explains the minimal rate cut seen last year, since the lack of sterilization may have reduced the scope of tools like rate cuts? More generally, how well do you believe the RBI has been managing the trinity between all these?
Yeah, so it's been challenging for the Reserve Bank. I think, like the markets, they also were surprised by the extent of inflows that was coming in. If initially started by a few telecom companies, but then it triggered into like a bit of a free for all in a way. So I think they have done a reasonably good job, and it has meant that the domestic balance sheet, because there are two components to RBI's balance sheet. There's a foreign reserve component and there's a domestic liquidity component. And what they have done is that they're basically used, as you rightly said, others, that they have not been sterilizing, and I think that's been the right call. What they've also done at the same time is that they are now normalizing other domestic liquidity measures, right? So the CRR hikes, which have been undertaken, first one in March, the second one will come in May. That will help in normalizing liquidity. You will have I think some normalization in the foreign inflows backdrop as well, because now India is no longer, like having negative growth. We are going to grow very strongly, and already there are signs that our economy is almost back to pre-COVID levels. And so, from that perspective, our current account is also deficit is also going to come back. So, I think the pressure on the RBI to keep having unsterilized FX intervention is going to be declining. My sense is that it's never easy for any central bank to manage the trilemma, the monetary trilemma, that they have been facing. And there are obviously quite a few asks right now on the RBI to manage the bond yields, ensure there is no inflation, or the inflation expectations are controlled, the currency should not appreciate, that the FX markets should remain range bound. So there's plenty of asks. And while it is challenging, I think they are doing a pretty good job at managing it. I think at any given point, a problem of plenty is a easier problem to have rather than a problem of too little.
That's true, sir. I completely agree with that. So moving to the third question, sir. So post 1991, multinational banks in India have expanded rapidly, including the likes of Barclays, JP Morgan, Deutsche Bank, among several others. So what is the roadmap for the growth for these multinational banks in India for the next 10 years? And what reforms in the BFSI space will be the most beneficial for foreign institutions, especially in the light of increase in FDI in insurance, which happened recently. So, what's your take on this, sir?
Yeah, so I think India has always been a very attractive market, especially with the way our banking system has been gradually liberalized, first allowing for private domestic banks to come back, and then we have obviously seen a lot of foreign banks having very large presence, both from an operational and from a financial standpoint. And I think one of the most exciting bits right now is obviously around the digital space, and what can be done in terms of improving the technology. Because I think one of the things that a lot of people recognize now, probably not a couple of years earlier, is that India's digital financial infrastructure is probably among the best in the world, if not the best, especially at the cost scale that we are able to kind of do a lot of these things at. And as a result of that, this technology advantage is going to be a huge propeller for growth in our financial services, right? And whether it is around tokenization, or like unit having bite-sized financial services being offered through payments gateways, etc., or you look at the deeper financial penetration that has come as a result of, I would say, a combination of demonetization, GST, and the fact that there were more than 200 million bank accounts which were opened under the Jan Dhan Yojana. You do see that financial savings in the system are increasing, and this is, I would say, not just for foreign banks or multinational banks, but even for local banks. I think it will be a huge growth propeller, right? So India's financial sector has always been a lot more developed than our underlying economic development. and that's obviously down to the way we run our financial sector. But then I think with the NPA issues kind of starting to get resolved, I think there's still some work to do over there. But then the financial space, the business space that opens up as a result of it, I think India is going to be one of the most interesting markets to watch for in the next 10 years, where you're going to have basically exponential growth in this particular sector, both in terms of the quality and the volume of transactions that we undertake.
Okay, sir. Thank you for that. And sir, the next question which I have is, so like there was a statement passed by the former deputy governor of RBI, like when he compared RBI's approach to that of a test match and government's to that of a T20. So what does this reflect, and what's your take on this?
Uh, so I think RBI, is basically like the risk manager in the country, right? So they are basically they're seen as, or the impression in Delhi, especially of the Reserve Bank, which sits in Mumbai, is that RBI is the person living upstairs, from a below, below above a house where there's a party going on, and they are the ones, who are saying keep it down, keep it down. So, but then I think everyone means well, right? And at the end of the day, I think the approach of the central bank is to basically ensure that there should be some sustainability to the growth that we are able to do, right? So effectively, they are the risk managers, but then obviously they also want to see growth to be very, very good and of very high quality, right? I mean, what we don't want is any kind of a sugar rush to be there in the system, and then to for growth to slump down. But then I think if we can improve the Sharpe ratio of our growth, which is, I think, the ultimate objective of the central bank, is that you keep on consistently growing at a reasonably good rate without creating a lot of risks around your financial sector or around your grow inflation. Then that's basically the best type of growth you can aim for. So that's how I think the central bank in India and other countries as well think about it. But it's always a bit of an agnostic relationship between the government and the any central bank in the world.
Exactly, sir. Okay, sir. So moving on to the next question. So RBI's bi-monthly monetary policy review is due April 7th, this April 7th. So it is largely expected to maintain status quo. So what are your views, and what are the important factors before the committee?
Yeah, so I think this is an interesting one, because while I think there's rightly a lot of optimism around growth and its prospects over the next 12 months. I think obviously this increase in COVID cases, particularly in Maharashtra, which is the biggest economically most relevant state in India, would be a bit of a dampener, right? And but at the same time, global commodity prices are rising. So we had written a report, I think, about a week ago, where we had said that this meeting is all about communication, because there's really no need for the RBI to do anything, signal any significant shift from where we were 2 months back. But then there's a lot of emphasis on how they communicate it, right? So it's all about talking the walk. So RBI has a certain path, but then they have to keep on explaining exactly how they see why they are not doing anything about inflation, or why they are not getting more concerned about growth. So I think that communication becomes very, very important in the upcoming meeting.
Okay, sir. So, sir, just the last question from our side. Okay, so there are a lot of talks going about for the privatization of public sector banks. So, what do you think? What are your views on the privatization of the public sector banks?
Yeah, so I think in the last, obviously India used to have very large public private sector banks before the bank nationalization of 1969, and then we had a subsequent nationalization in 1980. I think the idea of, as long as it's kind of deriving from efficiency gains, I would say we definitely need to think about it, right? I mean, we have already begun a process of consolidation as far as the banking system is concerned, where the number of banks, public sector banks, are being reduced, and they are being merged with one another. But then I think the public sector banks also have a very important role to play, because sometimes only being guided by say private considerations, and I'm not saying the private sector banks don't have equity considerations, but certainly the PSU banks at times tend to be a lot more quick through the gate on a lot of these schemes. So say something like Jan Dhan Yojana would have been a lot more difficult to execute only through the private sector banks, right? Because a lot of these bank accounts were seen as negative carry, because they were mainly deposit driven and they were not really going to bring any loans. So from that standpoint, I think there is a definitely a role for public sector banks, but then in order to make them more competitive, I think you do need more a more private sector supervision in some sense, right? So their behavior, their practices should be one of driven by efficiency, driven by profitability, and that is a sustainable path ahead, right? And that's something we have seen in several areas, including in sectors like aviation, telecom, where private sector entry basically is a benefit to the consumer, because what you see is that the demand for these services tend to go up, the cost of these services actually decline, and the end benefit, the consumer surplus, is with the consumer, right? So I think as long as we are able to get that, whether it is a public sector bank, whether it's a private sector bank, shouldn't really fundamentally matter, as long as we are not losing money on any institutions, and as long as we are driven by considerations of efficiency and profitability.
Okay, sir. Thank you so much. So that brings us to the end of this moderated Q&A session, and it was a pleasure interacting with you, sir. And
Absolutely.
yeah, and we are indeed fascinated by your insights in the arena of economics, finance, and consulting. And your words of wisdom will go a long way in setting the youth up on the path of innovation and change. And we are really glad to have got the opportunity to hear you and enhance our perspective. Thank you so much, sir.
Thank you very much. Good luck
Yeah,
to you.
it was an honor. It was an honor for SRCC to host you, sir. Thank you.
Right. Bye bye. Take care.
Bye, sir.